Thank you for tuning in to this video from NetPicks. And this one's going to talk about the best moving average for swing trading. And I'll just say that my favorite moving average as a swing trader, and it's one that I've used for years, is the 20-period exponential moving average. Now, everyone knows moving averages are one of the most popular indicators that are used by swing traders and just traders in general. And they are great if you know how to use them. You know, my trading style uses the moving average as supporting information. Price action is my main focus, as is common chart patterns. Now, when we're talking about EMA or SMA, which one's best, you know, we can debate that topic for years. And really, it's just a waste of time. Because in reality, it doesn't really matter what you use. Because the difference between these two is how they react to changes in price, right? And just like the name implies, each one of the averages, it's just going to average out X periods of price, right? Usually the closing price. A simple moving average, that's just an basic average calculation of the previous X periods, right? Whatever the period is you set for the average. The EMA, it still calculates the average, but more recent price data is given more significance. And that just makes it more sensitive to current price movement, right? So that means that it is not as affected to price shocks that occurred in the recent past. So if you want the average to react faster to changes in price, use the EMA version of the averages. The SMA, that's going to react a little bit slower, as well as not be affected by the large price shocks as well. Now, there are also totally different moving averages with completely different formulas, such as the Hall moving average, to calculate the plot that shows up on your chart. But the important point is that the success of a swing trading strategy, it should not rely on the moving average that you're using. If so, you may want to recheck your back testing and how you optimized your current method. What matters more from an indicator standpoint is really just the look back period that you're using. When we talk about look backs, is there a best period? This is where a decision has to be made, regardless of whether you're using an SMA or an EMA. And a lot's going to depend on the style of trading you use, right? And what you're using the averages for. As a lagging indicator, the higher the period setting, the more the moving average will be behind current price. So if you're using the moving average for trend direction, obviously the 10 EMA is going to confirm a change before the 50 or the 100 EMA. If you're a swing trader and you prefer a mature trend to swing trade against, you're going to be looking at using the 50 to 100 EMA, or even greater, right? Some people use the 200. As for the 20-period moving average that I use, it's just a medium-term indicator, shows a shorter-term trend. And I will say trend is a part of my strategy, but price action, momentum, and just a standard chart pattern, they play a larger part. So again, the best period for swing trading is just going to depend on what you are using the indicator for. And unlike most tutorials, I'm not going to give you a blanket average to use for your swing trading because the best is totally subjective. What's best for you is going to be different for me. One thing to consider is how robust is your trading strategy. So if you have to use a 21 period and not a 20 period, what's that mean? What if your system has to use a 10 EMA and not a 12 EMA, or just racks up the losses? What if it needs a 50 period EMA, but your results just fall apart with a 55 EMA? Well, then your strategy is not robust, and you've probably over-optimized it for the periods that you tested. And over time, that strategy is going to be totally useless. There is a but in there. The vast difference between a 10 period and 100 period setting can't be overstated. All right, so when we're talking robust, we're just talking about settings in the area of the one that you've tested. For example, a 50 and a 55 or a 50 and a 45. When we talk about using the averages for swing trading, there is nothing magical about a moving average. And I always say this, and I get some flack from it in the comments sometimes, but if you call them dynamic support and resistance, it's not really true. It can appear to be true. So for example, when the moving average holds price, and that was air quotes, you'll find plenty of examples where the prices blew right through them without hesitation, as if there was nobody there to buy or sell at those levels. And at those levels where price actually reacts, you're going to find some previous price level where current price is rejecting from. So let's look at the 10-period EMA. And this was a favorite moving average for Marty Schwartz. He's from the Market Wizards. And for him, the 10 EMA had to be under price to consider an uptrend. And he'd looking for buys. When price was under the average, sells were in order. This is a stock chart of Apple. It's a 10 EMA. And in a strong trend, price is going to stay above that moving average. So in those trades, as a swing trader, you're going to look for continuation trades to the upside. And you're going to see where price peels away from the average. And I labeled that MOMO. When that occurs, price could be overbought and reversal could be coming up. And we see that actually with the double top named DT. So as the stock price ebbs and flows, you're going to see the price showing splash. Okay, and this is just where price has broken the moving average. Okay, but it did not show a price structure change of trend. And far too many traders will trade these false signals. Okay, this is why it is vital that you use price action and price structure along with a trading indicator. But this short-term average, I think it's an objective way for you to measure momentum. Okay, it's not perfect, but it can certainly alert you to an increase in the volatility of the instrument you're trading. You know, a strong trending instrument, which is you want to trade that for swing trading, will tend to stay above the 10-period EMA. And at the first sign of breaking down, a swing trader, you're not going to see a whole lot of your profits being eaten away if you use a break of the average as a protective stop loss area. So now that's going to come with its own drawbacks, which you'll find in your testing. Now, before I go on, time period matters. So I'm going to use the 10 EMA as an example, okay? But it applies to any average that you're going to be using for trend. A trading indicator does not change the trend, okay? Just because a 50 EMA is pointing down does not mean it's a downtrend, okay? What changes trend is price. So a moving average on a daily chart is going to interact with price differently on a 15-minute chart. So market direction, we can break that down into the following price movements. A trend up is a series of higher highs and higher lows. Downtrend is lower highs and lower lows. So here, the daily chart shows an uptrend using the average, while the 15-minute chart with the 10 EMA is going to show multiple trend changes. So as you use a larger time period for the indicator, such as the 20 or the 50 period, price could actually be putting in a price action downtrend, while the average is showing an uptrend. So this is an example of why a best setting doesn't really exist, because if you're searching for it, you're just looking at things incorrectly, right? Optimizing for the best result will not necessarily carry through to the next month, the next week, or even the next day. Let's talk about the 20 EMA. It's a medium-term average, takes into account about 4 weeks of price data on the daily chart. As a swing trader, I find this is a nice intermediate term average, and it's a good tool for momentum reads and an idea of trend or lack of trend. So 20 EMA, for me, it gives price room to move, and it suits my way of looking at price charts. So this is just a top level look, but we see price snake around the average. I look for a trading range, and I see a higher low here, right? So I'm going to plan for a break to the upside. We have another trading range that comes off of a gap up, and price ranges long enough for the average to catch up to price, which gives the illusion of a moving average support. You see price pulling away from the average. That shows me momentum. It's not marked, but you all see a consolidation at the high, and that's bullish. Price pulls back into an area around the average price of the last 20 days, right? It just happens to also be an area where price had consolidated previously. It's to the left. So the average, I just use it to frame the market. It's not for a confirmation of any trading decision. let's look at the 50 and the 100 EMA. Both of these are longer term averages. And you're going to hear, well, institutions use them. I've never seen any data to suggest that to be accurate. I've never seen all these institutions being polled. There's no quantitative data to prove that to be true. Okay. So at this chart here, what we see is the closing prices over both these periods is increasing. Overall, increasing. Until we get to the end of the chart. Consecutive higher closing prices over a period of time, which the average is going to show, just means an uptrend. Now, there are a lot of different ways to trade this chart, but it really depends on your knowledge of simple price patterns. There are multiple pullbacks to around the moving averages where traders can use bull flags. These pullbacks pulled into areas where price was supported in the past. These are all trade entry locations that you could use. There's some caution here. I had said that traders should not trade technical indicators blindly. So if you were using the slope of the 50 EMA or a price crossover the 100 EMA as trend, well, you may have thought a bearish trend was forming. So after this push down, we see a long lower shadow, right? That shows price rejection. Price ranged for several days. This is the daily chart. And it was unable to break lower, right? That's generally going to be bullish. We see strong momentum to the upside. And if you were in a trade short, you got stopped out. Now, currently here, there's a consolidation at the highs of momentum, which is generally bullish, right? And if I just traded moving averages, I'd be looking to short. Well, the higher probability is a long trade. Now, can price break down from this current range for a short? Absolutely, it can. But successful swing trading, like all trading, relies on probabilities. So multiple moving averages. And when we get into that, the crossovers, we go down the rabbit hole now of finding the best settings for two averages. Again, there's no best setting. And if we accept that we're never going to catch the top or the bottom of a move with consistency, we can use these averages for swing trading. And one often talked about strategy is the 930. And there's going to be those who say that it doesn't work, whatever work means. But at its core, it's a pullback trading method in the direction of a trend, right? The trend direction is shown by the increasing or decreasing price of both the long and the short-term averages. And as a starting point, as a trader, there's nothing wrong if you accept the limitations of this. There's nothing wrong with using it. So some conclusions here. If you're looking for the best moving average for swing trading, there isn't one. Look, I know that's not a popular opinion, right? Because what it does is it takes the illusion of certainty away from everybody, right? What type you use is going to depend on how you look to use it. Now, more important than a moving average is how you manage your risk and how you take profits. Those are the more important aspects of trading, right? Spend time on those. Don't be the trader that just lets the losses add up while you take small little profits. And I actually put a video up about trading the daily time frame. And in that video, I used a 20 EMA and I used the ATR as part of the strategy. It takes into account closing price direction and the average range of price for stops and entries. That's not a bad starting point for swing traders. In the end, it's not going to be the indicator that's going to give you success. It can certainly help you frame the market. Absolutely, it can. And it can help you see things that you may not yet be able to see in price. Right? Use it as an assist to learning how to read price action and how to read price patterns. Anyways, I hope you enjoyed this video. I know it's tough to hear that there is no best setting and there's no perfection. But I know there's a lot of you out there that appreciate that because there's a lot of stuff out there promising the riches and that there's the best strategies, and they just don't exist, right? Every trader is different. Anyways, like, subscribe. Any comments, any questions? Hey, pop them below. Talk to you soon.